Welcome to another edition of The Savant Investor. Please support us by subscribing. 5 mistakes REIT investors should avoid during crisis. REITs invest in real estate, lease it to tenants, and trade on the stock market like a stock. They are a favorite with investors because of their high dividends and strong record of growth. Investors in REITs have been some of the hardest hit in the market meltdown that followed the emergence of the crisis. Amid the shutdown in many states, it is becoming difficult to collect rent from tenants, whether they are business or people. On top of that, they owe money too, since they finance their property with debt. While the thought of selling your REIT may feel good at the moment, this approach could cost you dearly in the long term, making the crisis even worse than it already is. REIT investors should try to avoid these common mistakes. 1. Selling at the bottom. Investing is all about buying low and selling higher. So when the market drops substantially, you want to evaluate whether you're selling only because the REIT has gone down or because you think it's going to fall further due to fundamentals. A REIT stock price built in the expectation of potentially millions of investors who are looking at all kinds of data: vacancy, economic growth, tenant problems, and many more. While price can always move later, it often takes news information to shift investor view of the REIT. The market is often effective at predicting the future. Good news can happen without you being aware of it, and often the good news can be attributed to investor becoming less pessimistic overall. If the situation changes in a favorable way, REIT values could actually go up, not down, leaving you having sold near the bottom. 2. Not analyzing a REIT carefully. It's important to analyze the industry carefully. REITs operate in many different sectors: healthcare, lodging, apartment, retail, and data centers. The dynamics of each of these sectors is tremendously different, so you can't take a one-size-fits-all approach. For example, data center REITs and tower REITs have held up reasonably well. They're still down from their height, but less than the broader sectors. Then there are the lodging and retail REITs, which have been sent reeling as it's unclear when consumers might resume traveling and shopping like before. Even healthcare REIT, which actually enjoy consistent demand, have been hit harder than you might expect. So you have to understand the dynamics of each sector. Consider these factors as well as the more specific situation of each company. Are tenants paying their rent? Is the debt load manageable? Will the company need to raise money in the future if the economy doesn't improve? Will the REIT fare well in the new economy? 3. Letting fear keep you from buying good REITs. If you have analyzed the company and the long-term future looks good, it could be a mistake not to buy more, especially if you're receiving a significant discount to what you think the REIT will be worth in the future. Don't let fear drive your decision. While REITs are known for their stable dividends, the current crisis has thrown one of that stability into doubt. If it isn't collecting its rent, it will have a hard time paying its dividend. So investors may already be pricing in a lot of potential for a dividend cut. But if that dividend cut doesn't happen, the stock may be primed to bounce higher. 4. Only concentrating position and not diversifying. If you're looking to buy REITs in a downturn, it can be a mistake to focus only on the ones that you own. Instead, it could be an opportunity to buy some of the high-performing stocks that simply looked too expensive before. For example, the growing digital economy has been great for some REIT sectors in the last few years: warehouses, data centers, and telecom towers. While many of these sectors have held up well, they're still below the 52-week highs. But the outlook for these sectors over the long term remains strong. By diversifying, you can reduce your portfolio risk while potentially adding some high-quality gems. It also helps balance the risk of one blowing up, giving the significant depth that is common for REITs. 5. Assuming things will return to normal quickly. While the market has bounced off its lows relatively quickly, it could be a mistake to think that the real economy will bounce back as fast. REIT have issues that are specific to them. They have to collect rent from tenants, and many tenants just don't have the money. So REIT may be slower to recover. On top of this, REITs are typically financed with significant debt, in the same way that homeowners typically borrow a lot to finance their homes. With no money coming in, REITs will have to figure out how to pay their own debts.
Bottom line, REITs offer an attractive way to invest in real estate for the long term. But investors need to treat carefully during this downturn, negotiating the path between careless optimism and myopic pessimism. The market's slide could offer significant value to set your portfolio up for decades of great returns, including a growing stream of dividends. But you will want to balance this upside against the potential for loss, especially if the economy weakens even further from here.